Hi, welcome back to Academic Market Insights. I'm Professor Russell Rhodes, joined by Dr. Larissa Demiak, Dr. A, and we're continuing on our series of videos about people's personal finance, personal financial situation. We came off number three where we were talking about retirement plans. Now we're actually going to dive a little deeper into what you really need to know about qualified retirement plans.
Mhm.
And with that, I'm going to hand it over to Dr. A and let her jump right in as you go along. If you like what we say, hit the thumbs up button. If you have other suggestions, and we've got a list of things that we're going to work on now, we are wide open to suggestions. My favorite suggestion is talk about things they don't talk about on the business networks. I would love to do that. So I think we are going to jump all over that one as we start going along. So with
Well,
that, I mumbled while you got set up. It's all you.
I want to take one time out for before we jumped into qualified pension plans. Our number one fan was listening to Bloomberg Radio over the weekend, and she heard an advertisement for take a what is it? Not so random walk, and learn about the hot topics of the financial markets. And she said, "Really? That's the the name of
That's
the
the
show, Not So Random Walk." And we were laughing about it because, a random walk is what we really think about the financial
hmm
markets. But I appreciated that the number one fan understood what a random walk was and the importance of it in the financial markets. Okay, having said that, let's jump into pension plans. So we're going to talk about some of the characteristics. We're going to again come back, circle to profit sharing plans, look at it again. This is a bit of iteration of defined benefits versus defined contributions, how it matching the pension plans with the needs of the firm. Okay, because we keep talking about how administrators are going to be making these decisions and these evaluations. And we'll talk very briefly about the limitations of life insurance. Okay, because when we sign up for a new job, one of the questions we're asked is, do you want life insurance? And that is a part of the compensation.
hmm
So our pension plans can come from, or we have two different types of defined benefits, the defined benefit pension plans and our cash balance pension plans. And we're going to define the contribution from with defined benefits with our money purchase pension plans and our cash balance ones with a target benefit pension plan. So our pension plan requirements, and again, and I hope to sound like a broken record. That is my goal here. Your
hmm
plan document needs to have all of these things in writing. You need to understand what they are. When you go to talk to a CFP or when you're thinking about your own decisions, you need to understand what these rules are. So there's going to be mandatory annual funding, and that's on the responsibility of the employer. It's going to really explicitly describe withdrawals from the fund itself, the limited scope of the investments. I remember in the early 2000s when we were talking about those shortfalls, one of the hot topics around it, and this could have been on the show, not so random walk. One of the hot topics around this was what types of investments can plan advisors get into to try to make up that shortfall. So, for example, a emerging market might generate a higher rate of return, but it's going to have substantially more risk. So, that type of investment might not be acceptable. However, at the time, there was this big debate of, well, how do we make that catch up? So, understanding what types of securities can be invested in. Also, and I hope not to be diving too deep into this topic, but understanding those types of securities also helps with your own personal, man, I'm drawing a blank. Having different assets in the groupings,
Well, it's your
diversification.
well,
It
it's
helps with your own
diversification, but it's
diversification.
also your overall the
Mhm.
way that I've heard it referred to, and it's not a common term, but it's your overall portfolio. The retirement is a part of it.
Right.
And as we go through this whole thing, where we talk about individual, and both of us at the respective schools that we teach at, we do teach this, that it's all, the whole course is all encompassing for your personal portfolio. But the retirement part's a big deal,
It
very
is.
big deal. Yeah.
But if you have a Roth IRA and you are heavy into large cap securities, and then you find out that your retirement is also heavy into large cap securities, are you truly diversified? So really understanding, to Dr. Rowe's point, that entire picture for your entire portfolio is very valuable because you might not be nearly as diversified as you think you are. So mandatory funding, I think, and again, in the early 2000s, it's not as big of an issue now, but this was the really hot topic of how do you make sure that that fund is properly funded? Or in the state of Illinois, it's still a hot topic because of the last portion, which is underfunding. So you are trying to set aside assets from profits to be able to grow as your employee grows with years so that you can be able to pay out those distributions at the end of their life cycle or in their second phase after the accumulation phase into the distribution phase, and making sure that that mandatory match is being done. And these mandatory matches are really done to safe or to protect the employee, right? This is really designed to protect. We're glad that these exist so that the employee, if they're a teacher working in Illinois, are going to be guaranteed to get those retirement benefits. So these are, we can also incorporate our life insurance into this. So how much investment are we going to be placing into our life insurance? Um, and there are some interesting rules for how much is invested. We also have interesting tax issues from that life insurance. So an actuary. And so just for our number one fan, an actuary is somebody who will try to essentially estimate how much life you have left. And really, if we think about the disbursement period of your life, I made in the last video, I made a reference to my grandfather who retired at 60, lived to 94. His wife then lived another 6 years. They would have needed to estimate that they were going to have to pay benefits for 40 years, which is very different if you're thinking about having retirement at 65 and a life expectancy of 72. That's a 7-year distribution period. So really understanding your employees, the expectations. In previous videos, we've discussed the age of retirement and how that's being pushed out. But by pushing out that age, then hopefully for the employer standpoint, we're then shrinking that disbursement period as well. And this is where the actuary can come in, and for different types of plans, an actuary is actually required for the defined benefit and cash balance. They need to come in once a year and reevaluate, right? And
Yeah, no, that makes a lot. I can see that
it
making an
does.
awful lot of sense. Yeah.
Um,
And life. I think that the tables that the actuaries are using right now for maybe people in their 20s and 30s are going to be very inaccurate as to what their ultimate lifespans end up being. There's several defined benefit uh, plans out there that are still paying people. Uh, and a lot of those people, they've been paying them longer than they ever worked for the company or the organization.
well,
You
and
know, and it's an issue, and it's why there are fewer defined benefit plans than there used to be. Right there.
getting back to your actuary tables, something that was brought up in one of my classes this past week, one of the students was questioning about how much money, because salaries haven't gone up relative to expenses.
Not at
And
all.
so the margins for younger people, so people in their 20s, are much smaller. So if there are medical things that come up, we don't know that people in their 20s and 30s will take care of them right now. So the
Mhm.
overall emphasis on just general wealth and not wealth, general health and wellness might get ignored. And if those things are ignored, the long-term impact will be then on your lifespan,
Yeah,
which will be
no, absolutely.
reevaluated by the actuary. So again, actuaries play are participants in defining and understanding to make sure that there is proper funding, which I thought was interesting
Mm.
and a little morbid. Um, and we've talked a little bit about this, about who takes on those investment risks. So for defined benefit, the employer is making the decisions for investments, for target benefits and money purchases. The employee makes the decisions of where those funds are going to be invested. They're both pension funds, but the employee takes on that responsibility and makes their own decision. Or at least they make decisions within the uh, catalog of choices that are available for them to make. They might not have the entire catalog of all financial products. However,
Mhm.
it's on them to make that decision as opposed to an employer. For example, Dr. Rowe, I'm going to ask you a pop question. In
Sure.
your 401k, can you trade options?
No.
Now, can you personally trade options if you want to?
Oh yeah, and I have an IRA as well, and I do trade options in the IRA.
So there are financial products that exist that retail investors can invest in that it might not be available to those in a defined contribution plan, or in this
Oh,
case, a
absolutely.
target benefit or money purchase plan. So I just want to throw it out there that it is not the entire universe of financial products that you have access to. Um, so make sure you understand that as well. And getting back to the full diversification of your portfolio, make sure you understand where all of these little pieces fit in.
One quick thing.
Yes.
And this is another broken record thing, like you said.
Mhm.
I do believe that if you end up at a company and you're not happy with the choices that they're giving you for your 401k, say something about it.
Yep.
I mean, don't go to HR every other day and be obnoxious about it, but this is, they may not realize there's an issue unless somebody says something about it.
And they might
Yeah.
not, even if there is an issue, or if they might feel that there's an issue, until there's enough people to support them, they might not have
Mhm.
enough knowledge to be able to do something about
Exactly. Exactly.
it. And it's their job to make you happy.
Yes, it is.
It is.
Mhm.
It's not just to protect the company, it's to protect the employee too. So fortitudes, pardon me, is money that's not invested. So in these situations, what happens is you end up getting a reduction in plan costs. So money that doesn't get vested. So people who walk away or are partially through a vesting cycle and then don't see it all the way through, this money then can challenge some of those costs associated with running these plans. Okay. The PBGCI, Pension
Very good.
Benefit Guaranty Corporation Insurance. Okay, so this was established in 1974 and it came about in conjunction with IRSA, which is the Retirement Income Security Act. And the objective, let me see, the objective is that if there's an issue with your pension plan, this insurance will kick in so that you might be able to still receive those assets or those rewards. So it works very similar to your car
Mhm.
insurance. You pay that premium every month, and it only becomes valuable to you if you are in a car accident. And that's when
Well,
you get the payout.
yeah, and the PBGC is a lot like the FDIC for your bank accounts.
Good
Yeah,
analogy.
I think a lot of people are familiar with that, and it's a very similar concept. I don't know if there's a cap on what the pension benefit guarantee corp does, but there's a I think there's $100,000 cap
Okay.
on people's if a bank goes under. I think it's $100,000. It used to be a lower number,
Oh, I thought it
but
was for 250 now.
is it 250? See, I'm
Mhm.
showing my age.
For
Um,
FDIC.
yeah,
And I'm
so.
sure there's a cap for the PBGC as well, given
Mhm,
that there was a cap for the amount that you could be maximized to be even in one of these accounts. So if the
mhm.
cap is $280,000 to get in, I'm sure the payout has a cap of for PBGC.
So I just found a number of $85,000.
Okay,
That sounds so low.
it does sound low.
So good. Sorry. Um, so an unconfirmed $85,000 there.
So insurance is only required for defined benefit and cash balance, not for target benefit and money purchase. And given that the employee is on the hook or is the person in charge for the reinvestment risk, that I think tracks versus
Mhm.
the employer making the decision. If the employer makes a mistake with some of these things, then that's when the insurance comes in. And again, this was created in conjunction with URSA really to protect employees. And this was back in 1974. It was a good year. Trying to think of anything
I
substantial happened in 1974.
I don't know. I turned 7.
Yeah,
I,
Michael Jordan wasn't playing for the Bulls yet. I
no, he wasn't even thinking about it. He
He
was getting
wasn't.
getting cut from his Pee Wee team or something.
Oh, terrible year then. 1974, we should mention again. Um, so for our different types of benefits, we accrue benefits in our defined benefit, and then we have an account balance for our target benefit. So when we accrue benefits, that means that during the life cycle, there is going to be a certain amount that as time passes will be collected. Um, I always think of it like as a dividend. You accrue that dividend. And if you were to sell that bond in between dividend payments, that accrued interest or that accrued dividend payment has valued, and it's very similar for our defined benefit. So if you quit mid-period, you still have generated value, and there is some benefits there. Um, we also look at some of these things as how do they integrate with Social Security? And this gets back to that big piece of diversification of your entire portfolio. So we're going to be looking at two different methodologies for how these integrate, the excess method and then the offset method. So for integrated integration
Huh.
of two, defined benefits can use either the excess or the offset methodology for integration versus target benefit and money purchase is excess only. Now, this is interesting. How are accounts, are they commingled
Oh.
or usually separate? And this is where the URSA and the insurance really comes in. Again, if they're commingled, and if you're the state of Illinois looking to fund all these teachers, these are all commingled accounts. You're not trading on behalf of each individual, you're trading on the collective, the aggregate whole. And that can sometimes bring up challenges versus target benefit and money purchase. These are separate, but it makes sense that they're separate because the employee is making those individual investment decisions. Characteristics, I always like this one. Okay, defined benefits, actuaries come in and do evaluations. Defined contributions, where we're making the decisions, actuaries don't come in. Investment risk for defined benefits, employer makes those decisions, they're on the risk. Employee makes the decision for DC, they're on the risk. Forfeitures could reduce plan costs for benefits. definitely reduces costs for contributions. Insurance for defined benefits, again, because it's employer, um, that's
Hmm.
going to be based on the defined benefits. None of that shows up for defined contribution. And then we just talked about the integration and the separate accounts. So this is just a table summarizing what we just went through. So there are a couple different formulas for calculating the benefits for our qualified pension plans. We can use a flat amount, a flat percentage, and then a unit credit formula. So our flat, and this is just a summary of what it is. So a flat amount, you're going to get paid a flat amount every single month. Uh, well, and I put this in because again, I think how could I say this? The agency problem is such a real problem when you're thinking about corporate finance. If you're
Mhm.
getting paid a flat amount, you don't really are not that invested in whether a company does really well or poorly. So there's no incentive for an employee to go above and beyond
No.
because they're getting paid a flat amount. Flat percentage is going to be based on your compensation. It's going to be 10% of the compensation. Again, your
Mhm.
compensation usually is going to be tied to some way, form of the company's fluctuations in value. Unit credit is going to be determined by service and compensation. So you're going to be more motivated to stay with the company and for the company to do well. So again, that's the combination of service and compensation. So our contribution of earnings, we can pay our credit or have interest credit. Different types of money purchase plans that exist are some of the issues with these is the contribution limit, the separation of accounts, the impact of younger versus older employees, the impact of the Economic Growth and Tax Reconciliation Act of 2001. Woo! That was a good year for reformation within the financial markets from legislation because another big one came out, Dodd-Frank. So we had lots of different things that were happening at that time period. And then we have eligibility, coverage, and vesting. And again, all of these things, going back to my broken record, are rules that should be listed in that document plan.
Mhm.
And with that, we wrap up our discussion on defined pension, qualified defined pension plans. If you enjoyed this video, please hit like. And if you have not, please subscribe to our channel. Please check us out on our website. We should be putting up a white paper fairly soon. That's pretty exciting and it's fun.
Yes.
Check out more videos on different topics on our YouTube channel. And if you have any suggestions or feedback, we are open to it. We'd be happy to check it out and you can send it to us via email. Thank you.